What if most of your money could grow quietly in the background without you watching the market every day? And the rest only needed 1 hour of your attention a week. That is not a fantasy. Professionals have used this structure for decades. Welcome to Signal Stock. This is the Lazy Investor's Portfolio. 7 real stocks. Here is the whole idea in one picture. The big slice, 80%, is your core. 4 quality companies you buy slowly and hold for at least 2 to 3 years. This money does not care about this week's news. The small slice, 20%, is your trading side. Signals measured in weeks, not years. 1 hour every weekend to review and adjust. Remember this: 2 buckets, 2 clocks. I will tell you which clock we are on for every stock. Never trust stock picks without seeing the filter behind them. For the core, every company had to pass 4 tests. Sales that keep growing in good years and bad. Real cash coming in, not just paper profit. A market position that is hard to attack. And a share price that fell less than the market when things got ugly. For the trading side, the filter is different. These stocks are picked for movement. Each one needs a clear upcoming event and an exact plan. A price that says, go. A price that says, get out. Core stock number 1, Visa. Think of it as a toll booth. Every time money moves through its network, anywhere on Earth, Visa collects a tiny fee. It does not lend money, it just collects the toll. Look at the buy zone on this card. It sits below today's price. The plan is simple. Do not chase the stock at its high. Set your price range, wait for the dip to reach it, and buy in small pieces. If it never comes down, you let it go. Patience is the strategy. Core stock number 2, Coca-Cola. This is the shock absorber of the portfolio. More than 60 years of raising its dividend every single year. And notice something, Coca-Cola also just hit a 1-year high. While everyone argues about AI stocks, money has been quietly moving into steady names like this. The boring stock is the one winning right now. Coca-Cola will never be your fastest grower. That is exactly its job. In a bad month, this is the stock that lets you sleep and hold everything else. Core stock number 3, AbbVie. A pharmaceutical giant that pays a solid dividend and just hit an all-time high, helped by good policy news for drug makers and a fresh acquisition. Now the honest part. After rising 40% in a year, the average analyst target is basically today's price. The easy money has been made. So the card says, wait. Let the price dip into the buy zone first. Earnings arrive at the end of July, and that report either pushes the story higher or hands you the dip you were waiting for. Both outcomes work for the plan. Core stock number 4, Microsoft. Down about 30% from its peak, while everything else in our core sits at highs. So why is it here? The business is fine. Cloud sales are growing fast. What scared the market is spending. Microsoft is pouring record money into AI data centers, and profits will feel that squeeze for a while. The market is repricing the timeline, not the company. That can mean a discount, but the chart is still wounded, so the rule is strict. Start small. Buy just 1/3 of your planned amount now, then wait for the late July earnings report. Growth holds? Add the next third. Growth cracks? Stop and reassess. You never bet everything on a falling stock, no matter how famous the name. That is the core. Now the fun, 20%. And I want to show you the method, not just names. Every Friday, I run a system called Apex Prime across 40 stocks. It finds what is actually moving each stock, checks the calendar, even checks whether company insiders are selling. Only then does it print a card. This is NVIDIA's card for the week of July 13th. Notice the date stamp. NVIDIA spent this year going sideways while its profits kept growing, which quietly made it cheaper. On Friday, it jumped back above a key price level. But read the card. It does not say buy now. It says buy only after breakout. A breakout means the price pushes above a level it has been stuck under and closes there. Our green light is one daily close above 212. Until that prints, there is no trade. That discipline is the difference between a system and a guess. This is NVIDIA's card for the week of July 13th. Notice the date stamp. NVIDIA spent this year going sideways while its profits kept growing, which quietly made it cheaper. On Friday, it jumped back above a key price level. But read the card. It does not say buy now. It says buy only after breakout. A breakout means the price pushes above a level it has been stuck under and closes there. Our green light is one daily close above 212. Until that prints, there is no trade. That discipline is the difference between a system and a guess. AMD has been the monster of the year, roughly 4 times higher than its low on real business growth. But my system automatically flags any stock that doubles in a year, and the check found heavy insider selling. That does not kill the story. It lowers the confidence. And here is the truth about these 3 cards. By the time you watch this, they have expired. Trading signals live for weeks, then die. The rules for the core never expire. The signals for the trading side do. That is exactly why I publish fresh cards every Friday. So here is the finished structure. The where and when to buy column tells you 2 things. For core stocks, it is a price range, where to buy. For trading stocks, it is a green light when you are allowed to buy. Core stocks you try to buy cheaper. Trading stocks you buy only after strength is proven. Opposite instincts, and that is the point. And notice today, not one trading position is a full buy. The system is saying, be patient. Patience is a position too. It is a framework with all the reasoning shown, so you can judge it yourself. The weekly signal videos are where the 20% comes alive every Friday on this channel. So my question for you, which side would you build first? The core that lets you sleep, or the trading side that keeps you sharp? Remember to subscribe to Signal Stock for weekly update.